Silver is trading near $76 on the screen, but try sourcing size in the real world. Dealers aren't panicking. They aren't discounting. In some cases, they're widening spreads. Why? Because the next 72 hours may not be about price direction. They may be about liquidity. There's a quiet stress test forming. Futures, positioning versus available inventory, headline catalysts versus physical premiums, and a narrowing delivery window that could reveal whether $76 is a bargain or just a number. The question isn't, will silver go up? The question is, what happens if the bid disappears? The $76 screen price versus the real transaction price. Silver was trading near $76 on the screen. The number looked clear and simple. For many viewers, it felt like a decision point. Either it was a buying opportunity or it was a warning sign. But inside the physical bullion market, the reaction was not dramatic. Dealers were not rushing to discount inventory. They were not advertising clearance sales. In some cases, they were adjusting spreads slightly wider. That quiet response is where the analysis begins. The screen price most investors see comes from the futures market. It reflects contracts traded in high volume, often for short-term positioning. That price moves quickly because it absorbs macro headlines, currency shifts, and large institutional flows. It is highly liquid, it is efficient in processing information, but it is not always the same thing as the price required to secure physical silver in size. In the retail and wholesale bullion trade, the relevant number is the transaction price. That includes the spot quote plus a premium. The premium covers fabrication, distribution, hedging costs, and dealer margin. When volatility rises, hedging costs often increase. When wholesale supply becomes uneven, replacement risk increases. In those moments, dealers tend to protect margin rather than chase volume. At $76, one might expect premiums to collapse if supply were abundant. In many markets, that has not happened. Instead, spreads between buy and sell quotes have remained stable or slightly wider. That behavior suggests caution rather than excess inventory. Dealers appear focused on inventory management, not promotional selling. This distinction matters because the futures market and the physical market operate on different mechanics. Futures contracts can be opened and closed quickly. Most are settled financially, not through delivery of metal. Physical silver, however, must be fabricated, shipped, insured, and stored. That chain introduces time delays and cost layers. When volatility increases in futures, the physical chain does not instantly expand supply. It adjusts more slowly. Observers sometimes assume that a falling futures quote means physical silver is easier to obtain. That assumption does not always hold. If the price drop is driven by macro positioning, such as interest rate expectations or currency strength, the futures market may react faster than the wholesale fabrication pipeline. In those situations, the screen price declines, while the physical transaction price remains relatively firm. At $76, another structural factor becomes visible: dealer hedging behavior. Most professional dealers hedge their inventory using futures contracts. When volatility rises sharply, margin requirements and hedge adjustments can increase short-term risk exposure. To manage that risk, dealers may widen spreads slightly. That adjustment does not signal panic. It signals cost control. From a business perspective, dealers operate on turnover velocity and margin discipline. They do not typically speculate aggressively on short-term direction. If they believed supply was abundant and replacement cost secure, competitive pressure would likely compress premiums. The fact that spreads have not collapsed suggests that replacement cost uncertainty remains part of their calculation. There is also the question of inventory depth. In bullion markets, availability can differ by product type. Small retail coins may behave differently from large industrial bars. Regional differences also matter. Transport costs, refinery output schedules, and import policies can influence availability. A global futures quote does not automatically reflect those regional variations. For investors watching $76, the critical issue is liquidity rather than direction. Liquidity refers to how easily an asset can be bought or sold without materially affecting its price. In futures markets, liquidity is deep under normal conditions. In physical markets, liquidity depends on stock levels and fabrication throughput. When volatility rises, that liquidity can tighten temporarily. This creates a subtle structural imbalance. Futures prices respond instantly to macro signals such as inflation data or interest rate expectations. Physical premiums respond to replacement risk and supply logistics. When these two reactions move at different speeds, a gap can form between the quoted price and the effective transaction cost. It is important not to frame this as misconduct or manipulation. Markets often show temporary divergences simply because they function on layered systems. Futures markets process information quickly through leverage. Physical markets process information through production capacity and inventory cycles. These systems can align over time, but they do not always move in perfect synchronization. At $76, another layer emerges: participant psychology. Retail investors often focus on headline price levels. Dealers, by contrast, focus on margin stability and supply continuity. A dealer's objective is not to predict whether silver will rise or fall tomorrow. The objective is to maintain inventory turnover without exposing the business to sudden replacement losses. If replacement cost becomes uncertain, for example, ahead of major economic data releases, dealers may act conservatively. That conservatism can appear as firmness in premiums, even during a price dip. It is a rational response to volatility, not an emotional one. There's also the role of contract timing. Futures markets operate on specific delivery months. As delivery windows approach, positioning adjustments can increase short-term volatility. Traders may close contracts or roll them forward. Those flows can influence screen price independently of physical demand. Observers who look only at the price chart may miss these timing effects. In summary, silver at $76 represents more than a number. It represents an intersection of two pricing systems. The first system is highly liquid, leverage-driven, and responsive to macro catalysts. The second system is inventory-based, logistics-sensitive, and margin-protected. When these systems react at different speeds, the gap between quote and transaction becomes visible. The quiet behavior of dealers suggests that they are watching supply channels carefully. They are not signaling distress, nor are they signaling abundance. They are managing risk in a volatile environment. That posture indicates that the story is not solely about whether 76 is high or low. It is about how liquidity behaves under stress. As the market moves into the coming days, attention will likely shift toward macro catalysts and delivery positioning. But before those events unfold, the present observation remains. The screen price and the real transaction price are not always identical signals. Understanding that difference is the foundation for interpreting what 76 truly means in the broader structure of the silver market. The 72-hour liquidity window. $76 was only the surface. Beneath it, a clock was quietly ticking. Markets do not usually reveal stress through dramatic headlines. They reveal it through timing. In the silver market, the next 72 hours matter less for price prediction and more for liquidity behavior. Liquidity is not emotional. It is mechanical. It either holds or it thins. In the futures market, positioning shifts quickly before major economic data. Traders reduce exposure ahead of CPI releases. They adjust before central bank meetings. They manage risk before delivery windows tighten. That repositioning can create sudden price swings, but those swings do not always reflect a change in long-term supply or demand. They reflect short-term balance sheet decisions. At $76, open interest remains meaningful relative to available deliverable inventory. This relationship does not automatically imply stress, but it does create sensitivity. If volatility rises sharply, margin requirements can increase. If margin requirements increase, some participants must either add capital or reduce positions. That process can amplify price movement in either direction. The critical observation is not that price may move. The critical observation is how liquidity responds when volatility increases. If bids remain deep and spreads stay orderly, the system absorbs pressure. If spreads widen and order books thin, liquidity becomes fragile. In physical markets, this 72-hour window plays out differently. Dealers monitor wholesale availability. They check refinery schedules. They watch transport costs and currency movements. They do not react instantly to a headline. They react to replacement risk. If replacement risk appears uncertain during a volatile period, spreads may widen slightly. That widening is a defensive adjustment. This creates a quiet tension between two systems. Futures traders manage leverage exposure. Dealers manage inventory exposure. Both respond to volatility, but their time horizons differ. Traders may adjust within minutes. Dealers adjust over days. During this window, one question becomes central. Does volatility create forced selling, or does it create opportunity buying? The answer often depends on liquidity depth. If selling pressure meets strong bids, the move stabilizes. If selling pressure meets thin liquidity, the move extends further than fundamentals alone would suggest. There's also the role of macro catalysts. Inflation data can shift interest rate expectations. Interest rate expectations can move the dollar. A stronger dollar can pressure commodity prices mechanically, even if physical demand remains steady. These cross-market interactions add complexity. Silver does not trade in isolation. It trades within a network of currencies, bond yields, and equity flows. But within that network, delivery timing remains a structural anchor. Futures contracts approach notice periods. Traders must decide whether to roll forward or exit. Most contracts settle financially, but the existence of delivery mechanisms influence behavior. As delivery windows approach, positioning becomes more disciplined, risk tolerance narrows. If open interest declines sharply during this period, liquidity is being reduced intentionally. If open interest holds steady while volatility rises, margin sensitivity increases. Neither outcome guarantees direction, but each reveals how participants are managing exposure. In the physical channel, premiums serve as a quiet indicator. If premiums compress during volatility, it suggests supply comfort. If premiums hold steady or firm slightly, it suggests replacement caution. These signals are subtle. They do not appear on most price charts, yet they shape real transaction costs. Another layer in this 72-hour frame is dealer hedging behavior. Dealers typically hedge inventory through futures contracts. If futures volatility spikes, hedge adjustments may become more frequent. That can influence short-term flow without indicating a change in physical fundamentals. It is a mechanical process, tied to risk control. This is why the coming days should not be framed as a binary event. It is not a question of up or down. It is a question of resilience. Can the market absorb volatility without distorting transaction spreads? Can both pricing systems remain aligned under pressure? Professional participants tend to focus on alignment. When futures prices and physical transaction costs move in harmony, liquidity is stable. When they diverge sharply, attention increases. Divergence does not automatically imply crisis. It signals a stress test. $76 therefore becomes less important than order book behavior. Analysts watch bid depth. They watch volume distribution across sessions. They observe how Asia, Europe, and North America respond sequentially. Liquidity can rotate across regions. A thin overnight session can appear dramatic, but stabilize once deeper markets open. The suspense in this window comes from uncertainty about participation. Will traders add exposure on dips? Will funds reduce leverage ahead of data? Will dealers widen spreads or keep them stable? Each action contributes to the liquidity picture. From a structural perspective, markets often reveal their true condition during high information periods. When data releases hit, reaction speed matters. If price stabilizes quickly after a shock, liquidity is robust. If stabilization takes longer, it suggests thinner participation. For business owners and investors observing silver, the lesson is analytical rather than emotional. Volatility is not inherently negative. It becomes significant only if liquidity weakens materially. Watching spreads, open interest changes, and premium behavior offers insight beyond the headline price. The 72-hour window is not dramatic on the surface. There are no alarms, no emergency signals. But beneath the calm tone of the market, systems are adjusting exposure. Traders manage leverage, dealers manage inventory. Both are preparing for uncertainty. In markets, preparation often precedes revelation. And in this period, the revelation will not come from a headline alone. It will come from how well liquidity holds when tested. The structural imbalance. No one sees at first. By the third day, the focus shifts. Not to the headline, not even to the price. It shifts to structure. Silver at $76 continues to trade. Screens flash green and red in small increments. Commentators debate direction. But beneath the visible movement, something more important is forming. A structural imbalance that does not shout. It whispers. Markets are not fragile because prices fall. They become fragile when confidence in liquidity thins. And liquidity does not disappear dramatically. It tightens quietly. The imbalance begins with leverage. In the futures market, silver contracts represent large amounts of metal relative to the capital posted to control them. This leverage increases efficiency during stable periods. It also increases sensitivity during volatile ones. When volatility rises, leverage feels heavier. Margin requirements can shift. Risk managers reassess exposure. Funds rebalance positions. This is not wrongdoing. It is risk protocol. But protocol has consequences. When leveraged positions adjust quickly, price can move faster than physical conditions justify. That speed is not a flaw. It is the design of liquid derivatives markets. Yet speed introduces a question. Does physical supply move with equal velocity? The answer is almost always no. Physical silver flows through mines, refiners, mints, wholesalers, and dealers. It moves in trucks and vault transfers, not in milliseconds. It is fabricated, stamped, inspected, shipped. That chain does not accelerate simply because futures contracts do. This difference in velocity creates the imbalance. If futures selling accelerates sharply while physical demand remains steady, the paper price can move lower without an equivalent increase in available bullion. Dealers watching this divergence do not panic. They assess replacement risk. They monitor wholesale quotes. They adjust spreads cautiously. From the outside, it may appear that nothing unusual is happening. But inside trading desks and bullion offices, there is quiet analysis. Open interest becomes a key variable. Analysts compare the number of active contracts to registered deliverable inventory. They understand that most contracts settle financially. Still, the ratio matters. It influences psychology and positioning ahead of delivery windows. If open interest remains elevated while price declines, tension increases. Participants begin to ask whether liquidation is complete. If open interest drops sharply, it suggests exposure is being reduced intentionally. Each outcome carries different implications for near-term liquidity. Then comes the second layer of imbalance, confidence in replacement cost. Dealers do not price based solely on today's screen. They price based on the cost to replace inventory tomorrow. If volatility suggests uncertain replacement pricing, spreads remain firm. If replacement supply appears abundant and stable, competition compresses spreads. The absence of aggressive discounting at $76 suggests caution. Not alarm, not exuberance, caution. Caution in markets is often misread. It is not a prediction of direction. It is a signal of uncertainty about short-term balance. The third layer of imbalance is psychological. Retail investors see 76 and interpret it emotionally. Some see opportunity, others see danger. Professional participants interpret 76 as data. They look at depth of market metrics. They examine bid stacks and offer layers. They monitor how quickly orders fill during volatility spikes. In the past, sharp moves in precious metals have revealed hidden weaknesses not through collapse, but through thinning participation. When large orders move price disproportionately, liquidity is not deep. When large orders are absorbed smoothly, liquidity is resilient. This is where suspense builds. The market may appear stable on the surface, but stability can mask concentration risk. If a small number of participants control a large share of positioning, their adjustments can amplify volatility unexpectedly. That amplification does not require conspiracy. It requires concentration. As macro catalysts approach, inflation prints, rate expectations, currency fluctuations, leveraged funds reassess exposure. Each reassessment alters the structure slightly. The imbalance does not explode. It accumulates. By the third phase of observation, the key question becomes this. If another volatility spike hits, who absorbs it? Will buyers step in immediately, confident in long-term fundamentals? Will sellers exhaust quickly because liquidation is already complete? Or will both sides hesitate, allowing spreads to widen briefly? This hesitation is the quiet tension at the heart of the system. Silver's price is visible. Liquidity confidence is not. Professionals track confidence indirectly. They monitor how Asia reacts overnight. They observe European morning flows. They analyze North American session depth. If one region sells aggressively but another region absorbs calmly, alignment remains intact. If all regions thin simultaneously, caution increases. There's also the issue of correlation. Silver does not move independently. It responds to the dollar, to real yields, to equity volatility. If cross-asset volatility rises broadly, funds may reduce exposure across the board, including metals. That can pressure price temporarily, even if industrial demand remains unchanged. This cross-market linkage adds complexity to the imbalance. The futures price may reflect global liquidity stress rather than silver-specific fundamentals. And yet, through all of this, the physical channel continues operating. Orders are placed, bars are shipped, premiums adjust modestly. There is no dramatic shortage narrative. There is no oversupply declaration. There is simply cautious alignment. The power in this moment lies not in prediction, but in observation. Structural imbalances rarely announce themselves loudly. They become visible only when stress tests occur. When the next wave of volatility arrives, whether from macro data or position adjustments, the response will reveal more than the price level ever could. If liquidity absorbs pressure smoothly, the imbalance resolves quietly. If liquidity hesitates, spreads widen, and confidence thins, the imbalance becomes visible. $76 remains on the screen. But the real story is not the number. It is the structure holding beneath it, and how firmly that structure stands when the next test arrives. The moment of alignment. By the fourth phase, the question is no longer about $76. It is about alignment. For 3 days, the market has processed volatility. Futures traders adjusted exposure. Dealers reviewed inventory. Investors watched spreads. Now the structure approaches a moment where both systems, paper and physical, must either confirm each other or drift further apart. Markets often look calm just before clarity appears. In the futures arena, open interest begins to stabilize. The initial repositioning around macro catalysts has mostly passed. Those who wanted to reduce exposure have largely done so. Those who saw opportunity have entered carefully. Volume is no longer chaotic, but it is still attentive. Traders are not relaxed. They are measuring. This is where suspense grows. If price holds near 76, despite prior volatility, it suggests absorption. Absorption means that selling pressure found willing buyers. It does not guarantee upward movement. It indicates balance. Balance in leveraged markets is strength. If price drifts lower but spreads remain orderly and volume moderate, it signals controlled adjustment rather than forced liquidation. That distinction matters. Controlled adjustment reflects deliberate repositioning. Forced liquidation reflects stress. At the same time, physical dealers review their own indicators. Wholesale quotes are checked. Replacement timelines are assessed. Orders from industrial clients are evaluated. Retail demand patterns are monitored. If premiums compress modestly during stabilization, it suggests improved confidence in supply continuity. If premiums hold firm despite price softness, it suggests persistent caution. Neither outcome is dramatic, but each carries structural meaning. The most powerful moments in markets are not loud, they are decisive. Alignment occurs when the futures price and the transaction price move together again. When volatility fades and spreads normalize, the system confirms resilience. But misalignment, even subtle, introduces tension. Imagine futures price stabilizing while physical premiums remain firm. That scenario implies that replacement risk remains uncertain. Dealers may be waiting for clearer wholesale signals. The screen price alone would not tell the full story. Now imagine the opposite. Futures volatility subsides and premiums begin to compress meaningfully. That suggests supply confidence returning. Dealers would be signaling comfort with inventory flow. The structural imbalance would be easing. These are not headlines, they are signals embedded in market behavior. Behind the scenes, professional participants are observing one more variable: participation depth. Are new buyers entering, or is price stability dependent on reduced selling? There is a difference. Stability built on fresh demand carries different implications than stability built on exhaustion of sellers. As global sessions rotate, each region contributes to the test. Asia may react first to macro headlines. Europe may extend or counter that move. North America often brings the deepest liquidity. When all three sessions absorb volatility without disorder, alignment strengthens. But if one session shows hesitation, thin bids, rapid price gaps, widened spreads, professionals notice, not as a crisis, but as information. The tension in this phase is subtle yet powerful. Silver's number remains visible to everyone. The structure behind that number is visible only to those who look deeper. For business owners and serious investors, this is where analysis replaces emotion. The focus shifts from, is 76 cheap, to, is the system stable at 76? Stability does not require price appreciation. It requires orderly behavior. It requires spreads that reflect cost rather than fear. It requires open interest that reflects strategy rather than panic. If alignment strengthens, the market resets with improved clarity. Participants regain confidence in pricing mechanisms. Volatility becomes a past event rather than an ongoing threat. If alignment weakens, even slightly, attention intensifies. Liquidity becomes the primary focus, not price targets, not narratives. Liquidity. This is the quiet power of the fourth phase. Markets are ecosystems. Futures contracts, dealers, refiners, and investors each play a role. When their incentives align, price discovery functions smoothly. When their incentives diverge, even briefly, structure feels tension. $76 was never the central story. It was the entry point into observation. The real story has been unfolding beneath it, through leverage adjustments, spread management, open interest shifts, and wholesale replacement signals. Each layer revealed something about resilience. Now comes the moment where resilience is confirmed or questioned. There will be no dramatic announcement, no sudden declaration, only behavior. If silver trades calmly, spreads normalize, and liquidity remains deep, alignment holds. If volatility resurfaces and liquidity hesitates, the imbalance remains unresolved. The market does not need noise to reveal strength. It needs reaction. And in the end, the most powerful signal will not be the price printed on the screen. It will be how confidently the system absorbs the next wave of pressure, and whether paper and physical finally move as one again. The decision point. No one can see on the chart. By the fifth phase, the market looks almost ordinary again. Silver still trades, the number still flashes, commentators still debate direction, but something has changed beneath the surface. The stress window has passed, the repositioning has slowed, the structure has either tightened or quietly strengthened, and now comes the real decision point, not for traders chasing short-term moves, for business owners, for long-term investors, for those who think in balance sheets, not headlines. Because at this stage, the question is no longer about volatility, it is about conviction. During the earlier phases, liquidity was tested. Spreads widened slightly, open interest shifted. Dealers watched replacement cost carefully. Futures traders adjusted leverage. That phase was mechanical. Now the market asks something different. Who is willing to hold exposure after uncertainty has passed? This is where suspense deepens. If silver remains near 76 and participation stabilizes, it suggests that the price level has found temporary acceptance. Acceptance does not mean permanence. It means participants are comfortable transacting at that level without urgency. If acceptance forms, volatility tends to compress. When volatility compresses, leverage becomes less dangerous. When leverage becomes less dangerous, capital slowly re-enters. That re-entry does not happen dramatically. It happens incrementally. But if acceptance fails, if liquidity begins thinning again without a clear catalyst, attention increases. Professionals start asking why. Is it macro uncertainty returning? Is it cross-asset stress? Is it simple caution ahead of the next economic data cycle? The most powerful moments in markets occur when participation either broadens or narrows decisively. Broader participation means more buyers and sellers are willing to transact confidently. Narrower participation means fewer players are active, increasing sensitivity to larger orders. For entrepreneurs and business owners watching this market, the key insight is structural durability. Durability is not about price targets. It is about whether the system functions smoothly under pressure. In the last several days, the silver market demonstrated something important. It showed how futures and physical markets can diverge temporarily without disorder. It showed how dealers manage risk through spreads rather than dramatic reaction. It showed how leveraged positions adjust without necessarily destabilizing the system. Now comes the strategic reflection. If 76 represents a level where liquidity holds, premiums behave rationally, and open interest stabilizes, then the structure is proving resilient. Resilience builds credibility. Credibility attracts capital. Capital supports depth. But if structural alignment remains fragile, if spreads stay defensive and participation thin, then patience becomes a strategic asset. Observers wait for clearer confirmation before expanding exposure. This is not about predicting a breakout. It is about reading behavior. Markets are communication systems. They communicate through liquidity, volume, and spreads. Price is only the headline. Consider the psychology at this stage. Retail participants may feel relief if volatility fades. Professional participants feel evaluation. They measure how much capital re-engages. They measure how quickly bids refill after small pullbacks. They measure how orderly large transactions execute. If large orders execute smoothly without widening spreads, confidence increases. If large orders cause sudden slippage, caution remains. There's also a broader economic context. Silver is influenced by industrial demand, investment flows, currency strength, and interest rates. None of these forces disappear after 72 hours. They continue evolving. But short-term liquidity tests often reveal whether the system is prepared for larger shifts. The suspense now is not loud. It is strategic. Will capital rotate back into metals if macro uncertainty rises again? Will industrial demand remain steady despite price volatility? Will futures positioning remain balanced or begin building new leverage pockets? Each answer unfolds slowly. For disciplined investors, the final phase is about framework, not excitement. Framework means asking, is liquidity stable? Are spreads rational? Is open interest aligned with inventory depth? Is volatility compressing or expanding? When those metrics point towards stability, confidence grows gradually. When they signal fragility, risk management tightens. The quiet truth is this: markets rarely collapse suddenly without prior warning, and they rarely strengthen sustainably without demonstrating resilience first. Silver at 76 has just undergone a resilience test, not a dramatic test, not a historic event, but a structural examination. And the result of that examination determines what comes next. If the system holds, 76 becomes a reference point, a level where volatility was absorbed and alignment restored. If the system weakens, 76 becomes a reminder that liquidity confidence was still forming. For entrepreneurs thinking about capital allocation, the lesson is timeless. Do not focus only on the number. Focus on how the system behaves around the number. Because markets do not move sustainably on emotion. They move on participation. They move on trust in liquidity. They move when both paper and physical systems operate with confidence. The screen will continue flashing prices. But the real story, the powerful story, lies in whether participants step forward calmly or step back cautiously. And that decision, invisible on the chart, is the one that ultimately shapes the next chapter.